Hello everyone, here is a quick video that's going to go through our reservation and move-in process, but more importantly it's going to align the financials and display what impact each function is going to have on the balance sheet and the income statement as we charge reservation deposits, batch and post receipts, and move residents into the property management accounting system, and as well as show incentives. We're going to look to see how that impacts the balance sheet and the income statement. Here we go. So in this first example, we're going to look at a reservation deposit that's being charged to the ledger, which this is going to be our reservation deposit workflow. So one of the first things we want to do is we want to charge the resident's ledger. And once we do that, we see that because we put a charge on the ledger, our accounts receivable increases, and we have a reservation deposit, which is a liability as we're looking at our balance sheet. So we have a charge and we have a liability, and our financials tie out. The next step will be to deposit that cash into the bank. And in this scenario, is going to be a third step, because when we put cash in the bank, the next step will be to notify the accounting system and the ledger that the payment was made. So once we do that third step, now we see that the cash increases. We see the accounts receivable goes away because we've been paid. And again, that payment is being hit on the ledger. Now it's the ledger of zero. So that financial statement is being impacted. That financial statement being the balance sheet is being impacted when we're doing the reservation process. No impact to the profit and loss statement. So we're going to go over to scenario 2, and or the next phase, where we will see now after a reservation deposit, now we need to look at what a move-in looks like. And when we have move-ins, now we're interacting with the income statement. So we have activity on the balance sheet. We're going to have activity that's going to show on the income statement. So first thing we're going to do, the business office leaders are trained to do, they want to check the ledgers before they do anything to the ledger. Then we're going to move the resident into the property management system. And then most of these systems have a component where you need to post those charges that you have in the queue. So in this case, we're doing billing and we had some move-ins, so we need to post the charges that we're going to put out there. So that would be step 3, and then it's going to be broken down into 2 sub-steps, which one would be to recognize the care revenue. Okay, and so we notice that now we have revenue. Once again, the accounts receivable goes up. So you see on the ledger, we've charged a prorated amount of rent based on a lease rate of $5,500. So that's prorated for 17 days. Then the next phase of that would be to recognize what once was the reservation deposit as a liability. Now we're recognizing that on the income statement as revenue. So it moved from here to there, and on the ledger we had an in and out. So we credited back the charge, which was linked to this deposit, which is why it went down, and then we put a charge out there for the income, which is linked to this account on the profit and loss statement, which is why we have the $2,500. And once again, our balance sheet is intact and everything balances. Now, one variation of that scenario is we want to understand what it looks like from a discount perspective. So we're going to clear this, and in this case, there's a $1,500 community fee concession that was given. And so notice that if that's the case, then at the time of the reservation deposit, we would have only charged the resident $1,000 because that's the cash that they paid. So we charged them charged them $1,000 in cash, and they paid $1,000, which is why on our balance sheet we have $1,000 in the bank, and we have $1,000 as a liability as a reservation deposit. And so when we go through our steps in checking the ledger, moving in the resident, and then getting to where we're going to post the charges, that next step is going to be the same, where we're now charging a prorated rent. AR increases, our revenue increases. And then now we're going to recognize the community fee income. So the reservation deposit will become the community fee income. Now notice what we need to recognize it as, because our community fee rate is $2,500. So when we hit that, we still need to recognize $2,500 of revenue, because that's what it is. The liability clears. But we also recognize with that a community fee concession, which if you net these two together, that's where the $1,000 of actual cash that we collected, which is the charge here, if that makes sense. So we know the next step is to deposit the cash into the bank. So we're going to deposit the cash into the bank. And again, these are broken into two different steps, because now we're gonna post it to the resident's account, and also putting it in the financials to show cash was received. Stressing the point of money goes in the bank first before we go into the ledger and say the resident paid, because we want to make sure that cash is in the bank. So we post to the resident ledger. Notice once again the AR clears, goes up to cash, and now we have the payment on the resident's ledger. The ledger's down to zero. We've collected the full cash or the full revenue less the incentive, which is why our cash is $1,000 less. Okay, that's the example for the day. Hope that's helpful. Thank you.